Hey, everybody. Thank you for tuning in. My name is Brandon. This is the Overseas DeFi YouTube channel. And tonight we have a really good show. This is where the rubber meets the road in DeFi. I'm going to actually show you the exact steps to set up a DeFi liquidity position. This is how we earn our daily cash flow. So real quick, what we do here is a 5-step process. Number one, we set up a self-custody wallet. That is a crypto wallet where you control everything. Number two, we buy some assets. I'm a big fan of Bitcoin, big fan of Ethereum. Tonight, I'm going to be looking at an asset called SWI. It's the latest generation in blockchain technology. Number three, we collateralize our assets on a decentralized lending protocol. That's a mouthful. Basically, what we're doing is we're lending some of our long-term assets onto a protocol where we can now take out a loan against that collateral. This is an over-collateralized lending and borrowing situation. So that's step 4. We borrow some assets against our collateral. And tonight is going to be all about step 5. We set up a liquidity position where we generate very nice high yields. And this is what we take advantage of here in DeFi. We borrow capital for a low rate and we earn interest or yield at a very high rate. So whatever we're paying to borrow the money, we're earning a lot more than that in these liquidity positions. And the difference, borrow low, earn high, it's pure profit. So I'm going to show you exactly how to set up one of these liquidity positions. It might seem daunting. There is, a little bit of a learning curve that goes into this, but we are going to try to go through every single step. Please do not hesitate to interrupt me and ask me any questions that you may have as I go through these different steps. Also, as you can see here on the YouTube channel, this video takes you through completely through step 1 and 2. And this one here is the DeFi carry trade. This is steps 3 and 4. And again, tonight is going to be step 5, setting up a liquidity position. You can do it small. If you're just getting started with this, start small. Do $50, do $100. Prove the concept. Understand the different buttons you have to click, setting up your range, figuring out which protocol to use and all of that. Step 5 for the win. Thanks, Jay. Good to see you, buddy. It's been a while. Yeah, so obviously I forgot to mention that, but I should have done the sound check. I'm assuming you can hear what I'm saying based on that comment. So I've also pinned the link to our website here at Overseas DeFi. We have our new community. This is $97 a month. It's free for the first 7 days. You can come in, watch all of the course videos, ask the AI. We have a DeFi trained AI to answer any of your questions that you have as you go through the process. And it can see your entire portfolio. So that's one of the beautiful things. You can set up your portfolio, your lens, your borrows, your assets on chain, your liquidity positions. Our protocol sees everything in one spot here under the portfolio, the academy, all of your courses and your workshops and your open office hour calls. Everything is recorded. Everything is searchable. Everything is available to the AI, as well as your full portfolio, all of your positions. The AI is going to be able to answer specific questions that you have about your portfolio. But enough about that. Let's go ahead and get into the topic for tonight. Again, we're going to set up a cash flow engine. One of the greatest things about providing liquidity in DeFi is you immediately begin to make money. I've done a lot of day trading in my life. I've joined different communities in day trading, chat rooms, live trading rooms, different strategies, different indicators, all sorts. There's no shortage of trading education out there. And we're providing education. That's what we do at Overseas DeFi. We don't control your wallet. We don't take any of your capital. We simply provide the education and the frameworks for you to be able to do this for yourself. The huge difference between learning how to trade and learning how to do DeFi is, I promise you, the moment you open a liquidity position in DeFi, you start earning profit. It's guaranteed. As long as you put your range, we'll talk about range and what that even means. As long as you put your range where the current price is contained within your range, you start generating cash flow immediately. Now, that's not to say that there's no risk. There's, of course, risk associated with crypto and DeFi. You can make mistakes. There is a learning curve to this, which is why, again, we have our community program. You're going to be able to interact with other members who are doing the same thing as you. Ping the AI, monitor your progress, go through all the courses and everything else. So we really try to make the barrier to entry very, as low as possible. But anyway, let's get into the material. So I've done videos in the past as far as how to set up a liquidity position. This one right here, just an 18-minute video if you ever want to watch that. And for the most part, when I'm talking about providing liquidity, I'm talking about the ETH asset. So that is the main coin related to the Ethereum ecosystem. Tonight's going to be a little bit different. I'm going to talk about a different coin that is called SWI. As I said earlier, the SWI blockchain is relatively new. And in my opinion, it is the best technology in terms of blockchain that's available in all of crypto right here now. Very fast, very low latency, very cheap transaction fees. They just recently launched futures on the CME. There's a big digital asset treasury company that just staked 182 million SWI. There's a lot of things looking up for this ecosystem. And I want to talk to you about how to provide liquidity for this asset. So this is a digital asset. SWI is the coin that makes the whole SWI ecosystem run. And when it comes to providing liquidity, you definitely want to provide liquidity for a coin that has a lot of utility. It's something that people want to own. They want to buy it. Maybe they want to sell it. All of that daily trading activity, that translates into your income as a liquidity provider. And that's another big difference. When you provide liquidity, you're literally providing a global service. This is a service that people actually use around the world every single day. You're providing liquidity that people can trade into and out of, and that's a real service that people use. It's not like you're trying to sell Amway cosmetics to your friends and neighbors. This is a legitimate business. There's a bit of a learning curve that goes into it, but hopefully I'm going to help squash that learning curve and flatten that out with the show tonight. Again, please do not hesitate to interrupt me and ask any questions you may have. A few of you tuned in live. I very much appreciate you guys being here for the live event. If you're watching the recorded version, thanks go out to you as well. Please remember to like the video, leave a comment down below, subscribe, turn on notifications, all of those good YouTube things. So let's get into this asset. Now, the first thing I want to do when I'm considering providing liquidity for a certain coin or token is I want to look at a chart. So this is just TradingView. And this chart, I have it zoomed in on a 1 hour time frame. So that means that every single one of these little candles, if I zoom in here, every candle represents 1 hour of trading. You can see it was quite bullish over the weekend. That's about when the SWI group announced their treasury being fully staked, taken away from the circulating supply. A very bullish event that happened, and we had this big ramp up. The reason I want to look at a chart is because when we provide liquidity here, we're doing so in what's called a concentrated liquidity pool. So in the old days of DeFi, circa 2020, 2021, in the olden days of liquidity, you would provide liquidity for the entire range of price. That's right, anywhere from 0 to infinity. Imagine if you're providing liquidity from 0 to infinity. Think about how thinly spread your money is. You have your money spread across the entire spectrum of price. Okay. What we do nowadays is called concentrated liquidity, which means we get to decide our price range. We get to set up a specific range. We say, hey, I want my money to be concentrated within this narrow band of price. And that way, all of our money is concentrated and we have a lot more capital in each little bucket of price. And that's how these liquidity pools are arranged. It's not analog, it's digital. There's buckets of price. So if we get to concentrate our capital within a narrow range, then we have more money in each bucket and we get a larger share of the trading fees. And I kind of skipped a step there. What are the trading fees? So what's happening on a decentralized exchange? It's just like Coinbase. If you go to Coinbase and you buy some Bitcoin, you're going to spend dollars, you're going to receive Bitcoin, you're going to have to pay a fee for that. And Coinbase has a business of collecting fees. That's how they stay in business. That's their revenue model. They're collecting free fees from traders and investors buying and selling crypto. It works the same way, more or less, in a decentralized exchange, except for instead of the fees going to a company, the fees go to liquidity providers like you and me. So this is an opportunity to benefit when other people trade. And this is around the clock. You set up your position. You don't have to monitor it constantly. As long as the price remains in your range, you're going to be earning from the fees when people swap back and forth. Now, the other thing to understand about a liquidity pool is it is always two tokens. And this is a blockchain function. It's a thing called a smart contract. So there's no company taking care of these trades and paying us our fees. There's a chunk of code. There is a smart contract that is facilitating the swaps automatically. When somebody swaps one token for the other, the smart contract takes care of that. And then the smart contract also takes care of collecting all the trade fees and then distributing those fees to all of the liquidity providers. So this is not only a legitimate business where you're providing a service, it's also a very consistent business. People like to trade all day, every day, as long as you pick a popular asset that people are interested, people want to buy, people want to sell, and it's a global phenomenon. Okay, so why do I start out by looking at the chart? It's because I want to decide where's my range? Where is the price now? And where do I think it's going to go in the future? Now, there is a little bit of prognostication there. We don't have to be perfect. We don't have to figure out exactly where the price is going to go down to and exactly where the price is going to go up to. Okay. In other words, I always say this, we don't have to hit the bullseye. It's more like you've got a big old side of a barn and all you have to do is just hit the side of the barn. You can do it. It's not that difficult. Okay. If you can figure out where price is likely to go in the future, even if you're off by quite a bit, you're still going to hit that side of the barn. You're still going to make money. As long as the price remains inside of your range, you make money. You get the fees when anybody swaps from one token to the other. So it's always two tokens, and you want to choose two tokens that you like. I'm a big fan of SWI. This is the latest and greatest technology when it comes to blockchain. And I'm happy to earn those trading fees in terms of SWI. And then my other token of choice is USDC. So USDC, most of you probably know that's a stable coin. Each token is worth $1. So it's very convenient when I'm earning fees in this liquidity pool, SWI paired with USDC. That's my fees. I earn SWI and I earn USDC, both. It's about 50-50. Okay, so the USDC, that's convenient, right? I can just take that right over to my Coinbase account, convert it into dollars, and withdraw it to my checking account, pay my bills, right? And that's what we're always talking about that. I don't know. By the way, I wonder if you guys liked the thumbnail tonight. Give me a thumbs up if you liked the thumbnail. I had quite a fun time creating that with Gemini, and when it came out, I was like, oh my God. That engine looks a little bit weird, but I thought it was pretty neat. Anyway, when we go and we think about setting up this position, we need to think about where's the price likely going to go. So this is going to be what we call technical analysis. And it doesn't have to be complex. Don't overcomplicate it. Don't put 17 different indicators on your chart. I'm what they call a price action trader. And so what I like to do is just simply look for the pivots. Where did the price stop going up and then start going back down, or vice versa? Where did the price stop going down, reverse, and start going back up? So right away, I mean, this doesn't take a trading genius to figure out. You can see there's a pivot point. Right? Price was going up very quickly and it came to a stop and then it started going back down. So I make a note of that recent pivot point. Also, I have a recency bias. I don't really care about what it was doing 3 months ago. Right? I don't even really care about what it was doing a month ago or 2 months ago. What's happened in the last week? That's important. What happened 2 weeks ago? That's also important. Okay. So I'm just going to go ahead and mark that pivot point. Okay. This doesn't have to be complicated. You can do this. So that potentially is a place where if the price goes up from here, it's not guaranteed to stop going up and reverse back down right there, but it's likely. It has a decent probability, and that's all we're shooting for. We're just trying to put the odds slightly in our favor, okay? We don't need to be, super accurate with this. Again, just hitting the side of a barn. Now, the other thing that has happened here, if I look back at the history, is I see a number of pivot points that are all more or less in the same spot. Now, there's some differences, but you can see like this high right here was at $1.02.7. Okay. This one here, $1.04.7. Pretty close. It was off by 2 cents. Here we had that same $2.7 and so on. So this high, they got a little bit excited there, but then look at that high right there. So all of these highs here, 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 right there, and right there, and right there. 6 or 7 different highs that all more or less line up. There's a little bit of a zone there. We could call that a resistance zone. Okay, again, just basic technical analysis. And what I like to do sometimes is actually just draw that zone in. In fact, I'll even go back right there too. So just kind of more or less in that area. Somewhere between $1.03 and $1.05. So I could very easily look at this chart, and within a matter of minutes, I have a decent high zone and a decent low zone. Now, again, nothing has to be perfect. We don't have to nail the exact bottom and nail the exact top. Just if we're in the ballpark, we're going to be okay. And again, as soon as you launch this liquidity position. That's why we call it an engine. You start it up, you're generating cash flow from the very first moment. Okay. Anybody can do this. Start small. Go through the learning process, sign up for our app for a free 7-day trial, watch all the videos, and go through these steps, those 5 steps I outlined earlier. Try it out. Proof of concept costs you nothing. I guarantee you'll have that moment, that aha moment, when you come back the next day, one day, 24 hours after starting your first liquidity position, and there's your money. There's your fees ready to collect and bring them right into your wallet. Okay, so I'm going to use these 2 levels as my range. So I'm going to set up a liquidity position where the top of my range is up here and the bottom of my range is right there. Okay, again, doesn't have to be perfect, and you can see where the price is right now. So right here and now, the price is maybe about a little bit lower than the halfway point. Let me drag this over here. Now, again, a liquidity pool is 2 tokens. And what people do, rather than trading on Coinbase, buying an asset or selling an asset on Coinbase and paying a big hefty fee to Coinbase, a lot of traders and investors like to buy and sell on a decentralized exchange. And why would they do that? Well, number one, they have full custody of their assets. A lot of people don't understand this, but when you have your coins in a Coinbase account, they're actually technically not your coins. You trust Coinbase and you believe that they're going to give you your coins if you ask for them, but technically speaking, they're not your coins. Those are coins that are in a Coinbase blockchain wallet, not your wallet. That's why that's the first step. The very first step to doing anything in DeFi is to set up your own wallet. You have to have your own blockchain account so that you can actually own your own assets. That's step 1. Excuse me a second. So why would somebody do a swap or a trade on a decentralized exchange rather than on Coinbase? Well, that's the first reason, because you actually own the assets. You get the coins in your wallet that only you control. But the other big reason is the fees are way lower, 2 orders of magnitude lower. I've had members that paid 1.2% to trade something on Coinbase. In DeFi, on a decentralized exchange, you're going to pay something on the order of 0.01%. So that's 2 orders of magnitude cheaper on your trade fees. So those are the 2 big reasons why anybody would do their trades, their buying and selling, on a decentralized exchange. That's the business model. You're providing liquidity for that kind of a opportunity. That's why DeFi is growing. We're headed towards a future where everything is on chain. All of global finance eventually will be on chain. I'm not trying to predict the future, but I'm very convicted in that future reality. Everything will be on chain. All financial assets will be tokenized and on chain. That's where we're headed. So this is an industry where you generate profits from day one, minute one. You fully own and control all of your assets in your own crypto wallet, your own Web3 blockchain account. And you're entering an industry that is so massively going to grow in the future. I was just talking with our community today about how BlackRock, the huge behemoth financial company, BlackRock, they just launched 2 new money market funds, tokenized money market funds on the Ethereum blockchain. The Ethereum blockchain is now up to an all-time high of real-world assets tokenized on chain. It's over $8 billion in real-world assets tokenized on the Ethereum blockchain alone. And this is just growing every single week, every single month. It just keeps growing. So you're entering an industry that is on the uptick. Imagine that. Everybody these days is worried about their company or their job going away due to AI. We're actually in a growing industry that's only going to keep growing. Okay. Not to mention, hello, the future of commerce is agentic. We're entering an agentic economy. We're entering an age where there are more AI agents than humans, a lot more. And the vast majority of financial transactions will be carried out by AI agents. Do you think AI agents are going to go fire up an account at Wells Fargo and wait 3 days to settle a payment? Nope, certainly not. So AI and crypto go together like chocolate and peanut butter, like white on rice. Gemini is worse than Coinbase. I've never used Gemini, but yeah, I was shocked to see some of our members, unfortunately, making some pretty big trades on Coinbase and paying 1.2%. It just hurts my soul. Anyway, I digress. So a liquidity pool, it's always 2 tokens. So it's a smart contract on the blockchain that is automatically facilitating the swapping back and forth between 2 tokens. So our decision is, what's our 2 tokens? And tonight I'm going to talk to you about SWI and USDC. SWI is a very nice up and coming layer 1 blockchain. USDC is a stable coin, very easy to off ramp that into your checking account and pay some bills. Okay, beautiful. Beautiful. So as we're earning fees, we're adding to our stack. We're getting more and more SWI for free. And we're also able to take some of that money back out into the real world, quote unquote, and pay some bills. So if the 2 tokens are SWI and USDC, we're going to provide those 2 tokens. That's how providing liquidity works. We're literally taking some of our USDC and some of our SWI, and we're putting those tokens into the smart contract. Okay, so we're depositing our capital into the liquidity pool. Once we've done that, the traders, they keep trading. They're swapping SWI for USDC. They're swapping USDC back to SWI. Millions of people around the world are doing this. Maybe not millions. Depends on the pair. ETH USDC for sure, millions. Anyway, people around the world are swapping one token for the other. Always the 2 tokens. So they're bouncing back and forth. What that means for our position, I call this a position. This is a liquidity position. When we set up that liquidity position, we start to earn fees, and the traders start to trade our capital. What does that mean? It means that our money, our 2 tokens that we put in there, those are used to fill the orders of traders. Okay, that might not make sense to you. If you're not a trader, maybe you don't know or understand, or you're not familiar with the idea of a trade order. It's not even the way it works technically on a decentralized exchange. But what happens is, to say this simply, if a trader comes up and connects their wallet and does a swap, let's say they want to buy SWI. Okay, so they've got some USDC in their wallet. They're going to send that USDC to the liquidity pool. So the USDC leaves their personal wallet, goes into the liquidity pool, and then the smart contract figures out, okay, you sent me 100 USDC. You therefore get to receive this many SWI. I'm not I'm not even going to try to do the math on that. The smart contract takes care of it. So I don't have to do the math. Okay. So that's what happens from the trader's perspective. It doesn't have to be a trader. It could be an investor. Either way, if somebody steps up to that liquidity pool, they're going to swap their USDC for SWI. Now think about it from the other perspective. That was the trader. What about the liquidity provider? So that trader wanted to buy SWI. So they sent USDC to me. I'm a liquidity provider. They sent the USDC to me. So I got that. And then I gave them some SWI in return. Now, again, all of this is completely automated. It's a smart contract. It's code on the blockchain that's facilitating all of this. But you have to wrap your mind around the idea of being a liquidity provider. You're taking the opposite side of every swap. Now, it's not just you. There are other liquidity providers, but it's proportional. If you put X amount of dollars and other liquidity providers put their money into the pool, you guys are all facilitating those swaps, and you're all getting a portion of the fees relative to how much money you put into the pool. So I'll say that again. Let's say a trader is going to buy SWI. They're going to send USDC to us, and we're going to give them SWI back. When I say us, I'm talking about the liquidity providers. So they send me some USDC. I send them some SWI, fully automated. To say that another way, if traders are buying SWI, I'm selling. Every time another trader comes along and buys some more SWI, they're giving me some more USDC, and I'm giving them some SWI. So from my perspective, I'm selling every time somebody buys. And then likewise, anytime somebody sells, I'm the one doing the buying. So we're, as liquidity providers, we're always taking the opposite side of every single swap. Okay, I think I've beat that to death. Sufficiently beat it to death. So let's look at this range. I'm going to delete this. I'm just going to clean this up a little bit. I'll get rid of this as well. Let's just say this is going to be our range. Okay. You want to think about this as a little store where you only have two things on the shelves. You've got two shelves. On one shelf, you have USDC, and the other shelf, you have SWI. And every time a trader comes into your little store, they're either going to give you some USDC and take some SWI off of your SWI shelf, or the opposite. They're going to put some SWI onto your SWI shelf and take some USDC. Okay. So think about this box as our two shelves. And then I'm going to draw a price. Let's pretend that this turns bullish and the price starts going higher and higher. If the price is going higher, that means most traders are buying. That's what makes the price go up. You got more buyers than sellers, and the price goes up and up and up. So if traders are buying, our liquidity position is selling, right? We always do the opposite side of every swap. So the majority of traders, as the price is going up, they're buying. That means our position is selling all the way up, right? So when you look at this drawing and you look at this box, you have to think of it in two sections, your two shelves. One shelf is from the current price all the way up to the top of your range, and the other shelf is from the current price down to the bottom of your range. Those are your two shelves. Now, again, if the price is going up, traders are buying, our liquidity position is selling. So this is my SWE shelf. Oops. That's my SWE shelf. I need to stock that shelf just in case traders start buying. I need a shelf full of SWE for them to buy from me. And then this lower shelf, that's going to be the USDC. So when you're getting ready to set up your liquidity position, you have to figure out where you want your range. It doesn't have to be perfect. You don't have to be a genius day trader to do this, not anywhere close. Just make your best guess. Hey, look at that. The price turned down right there. If it goes back up there, it'll probably turn around again. Right at that same level or close to it. Doesn't have to be perfect. We had this area where it kept functioning like a ceiling on price, right? That zone that I had in here, I shouldn't have deleted it now, but for months, the price kept getting shoved back down. And then we had this large breakout here just over the weekend. And so the thesis here, the idea is if this price zone was resistance, meaning it kept a lid on the price in the future, because we've now broken out higher in the future, that's now going to be a support zone. This is a phenomenon that happens in price action where a resistance level becomes a support level. And it happens the other way too. A support level can, if price breaks lower, that support level can become a resistance level. So you set up your range, just ballpark it, and then you need to load up those two shelves. And this is how you figure out what to put on each shelf. To give you an example of sellers coming in, if a lot of people started selling SWE, price is going to go down. If the traders are selling, our liquidity position is buying. Okay, how do we buy SWE from a trader? Well, we give them some USDC. So this is our USDC shelf down here. Okay, now I'm going to clean up the chart once again. And if you look at this, again, you can just kind of estimate this. Oops. I can just look at this range and look at where the current price is, and I can just estimate it. It's going to be about, I would say that's about 60% of my position is going to need to be SWE. And then 40% is going to need to be USDC. Now, modern decentralized exchanges have what's called a zapping function, where you don't even have to figure out this math, as if that's really all that difficult. I mean, I just did it. It's about 60% SWE and 40% USDC. That is the balance of our position. So the balance of our position is, what are we going to have to deposit? We have to deposit both tokens into the pool. And in this case, based on the parameters here, we're going to have to deposit about 60% SWE and about 40% USDC. If you're doing $100, you'll need about $40 in USDC and about $60 worth of SWE. If you're doing $10,000, I wouldn't recommend it. If this is your first time, start small, learn the ropes, learn the steps, learn the process, figure out what to click. You might make some mistakes. I'd hate for anybody to lose $1,000 by making a mistake, where if they just started small, maybe they only lost $100. By the way, very, very important. If you learn nothing else from watching this video tonight, please learn the #1 rule in crypto and DeFi. Okay, this is the most important thing that I have to teach anybody. I'm astonished and deeply saddened every time I hear about another person falling for one of these scams. There is a thing in crypto called a seed phrase. The seed phrase is your master key to your entire crypto portfolio. All of your wallets on all of the different blockchains, it all boils down to that one seed phrase. It's a string of words, looks random if you've never seen one, just looks like a random set of words. It's going to be 12 words, maybe 18 or 24 words. That seed phrase is your entire wallet, all your coins everywhere on every blockchain. Okay. So obviously that seed phrase, you got to keep it to yourself. It is your master key. And anyone who holds that seed phrase has full access to everything that you have. It's no longer yours. If somebody gets your seed phrase, those coins are gone. They're going to drain your wallet, every single coin, every single blockchain. It's all gone and you've lost everything. So that's why it's so important. That seed phrase is everything in crypto. And the rule is very, very, very simple and easy to follow. You just never give out that seed phrase. Okay. Obviously, if somebody calls you on your phone or hits you up on Telegram or sends you an email asking for your seed phrase, you're going to be like, yeah, get bent. You know, that's an easy scam to detect. Your alerts are going to go right off, and you're not going to just give your seed phrase to somebody. But you'd be surprised. Some people fall for even something as simple as that. These days, the scams are way more sophisticated than that. And what ends up happening, again, this has happened more often than I can barely even handle. It is so frustrating and so sad when somebody loses hundreds of thousands of dollars because they've fallen for one of these scams, is they will social engineer you / phish you, and they will get you to go to a website and enter your seed phrase. So you're not literally telling some person your seed phrase, but if you go to a website and enter your seed phrase into the website or into the app or whatever they sent to you, it's the same thing. Your seed phrase is no longer yours. You've just shared your seed phrase with a scammer and all your money is gone. Okay. So it's very simple. You just never share your seed phrase with anybody or anything. You don't put it into an app. You don't put it into a website. You don't put it into an email. You don't even keep a digital copy. Make a hard copy. Etch it into a piece of sheet metal or titanium. Okay. Physical hard copy only. You protect it from theft. You protect it from fire. You protect it from flood. And you protect it from other people. You never share it. Okay. Enough about that. Please, please, please do not share your seed phrase online with anybody. There's never a legitimate reason for you to give your seed phrase out to anybody or anything, ever. No legitimate reason for that. All right. So yeah, start small. And what I would suggest, I need to basically burn through the rest of this content and the rest of the process here fairly quickly. Good news is we're pretty much done. The hard part, quote unquote, is figuring out your range. Not really hard, and you're gonna make money regardless. Over time, you'll get a better feel for the charts and how the price moves, especially if you're very familiar with the asset. Spend some time researching on YouTube how to do technical analysis, but I just gave you the basics, and honestly, it's more than good enough. Then the next part is to go ahead and deposit the money into the smart contract, into the pool. Now, in SWE, we use a wallet app called Slush. You can set this up at slush.app. Be careful with URLs in crypto, by the way. The scammers will set up fake websites that look like the real thing but aren't. So that's another attack vector for crypto and DeFi is going to a fake website. So this one is called slush.app. Very simple. Download this. It's a browser extension. You can do this on your phone as well. I do everything on browser. But once you have that Slush app set up, now you have your wallet. You can buy a little bit of, SWI on Coinbase. I mean, if you don't have any crypto and you want SWI, you'll have to buy at least a few dollars worth of SWI and send that from your Coinbase account to your Slush wallet. And by the way, setting up your Slush wallet, it's exactly like the other wallet app that we like to use here at Overseas DeFi, which is called Aave. So you can watch this video on the channel. It's only 5 minutes, and this is going to show you how to set up a Aave wallet. Setting up Slush, it's almost exactly the same process. You download the app, set up your seed phrase, make sure it's a hard copy, no digital copies, and you're off and running. You have your Slush wallet. The other thing you're going to need on the SWI blockchain, and pretty much any blockchain these days, you need some gas money. So these are the transaction fees that we pay to the blockchain to process our different crypto transactions. So in the case of SWI, you need SWI. And if you're just starting out, you have no SWI, you just loaded your Slush wallet, you're going to need a little bit of SWI. $3 or $4 or $5 is plenty. These gas fees are microscopic. A lot of times the gas fees are less than a penny. Okay. A few bucks. I don't care about the 1% trade fee on Coinbase if I'm only buying, $4 or $5 worth of SWI. The rest of it, if you're going to do more than just the gas fee, which obviously you will, I would say the cheapest way is to convert dollars to USDC on Coinbase. That's free. They don't charge a fee to convert US dollars to USDC. Once you have the USDC, that's what you can send from your Coinbase account to your Slush wallet. So get yourself a few dollars of SWI. You'll have to pay the fee on that on Coinbase, and then convert some dollars to USDC and send both of those assets from your Coinbase account to your Slush wallet. By the way, your wallet has a unique address. This is your account. If you come into here, my account is on Ledger, which is a hardware wallet, which I'm not going to get into, but that video covers it. You can get your address right here. Just copy that address. That's your destination. Send the money from Coinbase to that address, and it'll show up. Again, start small. Start out by sending just a few dollars and make sure it shows up the way you expected, and then do the rest after that. So SWI and USDC, that's what you would start out with just to get started in providing liquidity on SWI. The next thing we need to figure out is which liquidity pool are we going to use? Now, this is a website called DefiLlama, and one of the things we can look at here is the yields. So what we're seeing here, I've searched for USDC paired with SWI. That's the pair we're interested in. And it has given me a ranking of which pools are paying the best yield. So yield is a function of volume and how many people use this pool and that pool to do their trading. It all factors in. And what I like to do is look at the 30-day average APY. So this is giving us an idea of the annual yield based on the last 30 days. Now, I would say, obviously, this one is coming out on top. I personally have never heard of this DEX. Maybe it's new. Maybe I just haven't been staying up to date with SWI. I've never heard of it, so I skipped this one. I also looked at the TVL. So the amount of money that's in that liquidity pool is only $380,000, which is not a small amount, but in DeFi, it's pretty small. It's not the deepest liquidity pool I could imagine. The next one on the list is Cetus. Now I've heard of that, and I'm seeing the TVL almost $6 million. That means there's a degree of trust there. People have trusted this protocol with $5.7 million of liquidity. That looks a lot better to me. There's a little bit of difference on the average 30-day average APY. Oh, well. Okay. So this is the pool that I selected, or I'm going to select when I'm setting up this position. I believe you can just click right into it from here. I'm going to go to the actual protocol. So this is Cetus. The URL for this is app.cetus.zone. Okay. Let me go to the earn section and go to pools. And here's the one right there. This is the 0.25% fee tier, which is the one that we saw on DefiLlama. And the fee tier, by the way, that's just the fee that traders pay to the liquidity providers. It's a liquidity provider fee, is another way of saying it. So that's the pool that I want. I'm just going to click on deposit. It's that simple. Now, again, this protocol, not all protocols have this, but this one has a zapping function. So remember, I was talking about the math, and I spent a lot of time talking about 60% SWI on the SWI shelf and 40% USDC on the USDC shelf, right? So protocols that don't have a zapping function, you have to kind of figure that math out, because remember, you have to deposit both tokens. If you're setting up a liquidity position, you need both. And you have to balance it out based on where's the top of your range, where's the bottom of your range, and where's the price currently trading, right? So you kind of had, without the zapping function, you kind of had to figure that out and do the math. Not difficult, but the zapping function just makes it so much easier. There's a little tiny bit of a fee associated with this. I'm not sure exactly what it is on Cetus. I don't know. Maybe it's even free. It's probably really small, if anything. And now, rather than having to do the math, I can just zap in a single asset. The protocol is going to do the math for me. It's going to do the swapping, and it's going to do the deposit all in one click of the button. Okay, so very convenient. I don't mind sometimes paying a little bit of a tiny fee just for that convenience, especially if you're just starting out. Like, you can just save yourself a whole couple of extra steps here by just using the zap function. So we're going to use the zap function, and now I just have to select, okay, which of the two assets do I want to send in and deposit into my position? Now, again, I would recommend, if you're just starting out, only buy a few dollars of SWI and maybe buy or convert $100 of USDC. Again, start small. There's no reason to start out with a huge position. You might make a mistake. I'd rather somebody only loses $100 versus, $1,000, $5,000. If you make a mistake, you send the capital to the wrong place. Remember, again, as you're doing those transfers from Coinbase to Slush, start out small, make sure it crosses over, check your balance on your Slush wallet. Okay, there it is, and then send the rest. Okay, so you're going to have a few dollars of SWI, maybe $100 of USDC. So just choose USDC. And this protocol, this zapping function, is going to take care of everything under the hood. Okay, now I happen to have $137 in my wallet. And by the way, how does it know that? That's because I connected my wallet. So if you're going to this website for the very first time, you'll see a big green button up here that says connect. And what that's going to do is it's going to connect the website to your Slush wallet. It's not dangerous. All that's happening is that the website, the protocol, is now able to see the contents of your wallet. It can't do anything with it, can't drain anything, although Cetus never would. Cetus is a trusted protocol. But just connecting your wallet allows it that visibility to where it can see the balance of your wallet. And the protocol knows right here that I have $137.84 of USDC. So I'm not going to actually go through this transaction because I already have an open position. I have had since a week ago. And I would just have to decide, okay, how much money, how much capital am I going to deploy into this position? Okay, so I'll put $100 there. And then over here, you can see the range. Now, what did we decide? We looked at the chart. We saw this pivot here. We saw this resistance zone that potentially will become support. And so we decided that our range was going to be from, let's just call that $1.05 all the way up to, let's say, $1.41. Okay. So $1.05 all the way up to 141. So just set that up in the protocol. You can just type it in. 105, tab over. And $1.41. Now, by setting up our range like that, what that means is that as long as the trading continues to stay within that range, we are earning fees. Sometimes the volume will be high. A lot of people are swapping a lot of tokens, and there's a lot of fees being generated. So we're earning a very high yield. Sometimes it'll pull back and there's not so much volume going on. So more volume, more fees for us. Less volume, less fees for us. But I guarantee you, after a day or two, you will earn fees. This is a profitable business from the very first moment that you set up a liquidity position. Now, just one little caveat here, or one little side note. What I like to do as a business owner, a DeFi practitioner, I like to borrow capital and use borrowed capital to earn my cash. Okay, that's the philosophy here in this video. Borrow low, earn high. Borrow low, earn high means that we're borrowing capital from a lending protocol and we're paying something on the order of 4 or 5%. And when we're taking that borrowed capital and shoving it into a liquidity position where we're earning a lot more than 4 or 5%. I'll show you in a moment this position that I've had open for the last couple of last few days has been earning something more than 100% per year. It's only been a few days, but that's the kind of difference when we're talking about borrowing low and earning high. And it's a lovely way to leverage your investments. So I own a bunch of Bitcoin, I own a bunch of ETH, I own a bunch of SWI as well. All of those assets are just sitting there in lending protocols, hopefully appreciating in value as the price goes up. I don't really care about the short-term, day-to-day price movements for my assets. These are long-term assets, and I'm very convinced that, you know, over the next 3 to 5 years, these assets are going up in value. So I'm holding those assets and I'm collateralizing them. I still own them. They still go up in value while I'm waiting. But then I'm borrowing this extra capital, and that's the money that I'm going to plug into my DeFi engine, right? That's how I'm going to start up my cash flow engine, is with borrowed money rather than my own money, if that makes sense. It's a strategy that's called increased velocity. So we're increasing the velocity of our capital. We're not just investing $100,000 into Bitcoin and ETH. We have that, but then we borrow 30, 40, 50K and put that into another instrument that generates cash flow. So we're burning both ends of the candle, so to speak. Anyway, so that's the DeFi carry trade, borrow low, earn high. Let's finish out this position. So I set up my amount I'm going to deposit $100 into this position. I set up my price range and I can just zap it in. Now, under the hood, what's going to happen here is Cetus will trade the correct amount of USDC over to SWI, and it'll load both of those shelves. I don't know why this isn't working. I was going to cancel the transaction anyway because I already have an open position from last week. So the zapping function takes care of everything. It swaps the correct percentages from USDC into SWI. It loads those two shelves for you and sets up your position. You'll get a lovely NFT in your wallet as soon as the position is open. And again, from that moment, you start earning fees. Now, if you're only putting $100 into there, it's going to be a few pennies. You know, maybe you'll come back the next day and you will have earned, well, let's see. I've been earning about 0.4%. So it'd be about 40 cents. So, you know, right away, you're not going to see much. But if you come back 24 hours later, you're going to see maybe 20 to 40 cents, maybe even more, maybe 45 cents off of a $100 position. Figure out the numbers. You know, so if I came back the next day and I put $100 in, right? And I had, let's say I had 40 cents when I came back the next day. Those are the fees that had accumulated. If I divide that by the $100 that I put in there, that tells me I earned 0.4% in just one day. Okay. What about a month? Well, just multiply that by 30. That is 12% per month. Now, most of you out there probably would be pretty happy with 12% returns in a year. We're talking about in a month. And this is not hyperbole. This is this is real life right here. Now, I can't, obviously, there's no guarantee here. Maybe the volume drops off. Maybe the price escapes your range. Maybe your technical analysis didn't come true and the price ran higher and jumped out of the top of your range, or maybe it dropped down and escaped the bottom of your range. If the price goes outside of your range, that's a whole other topic. Okay, that's a decision point. If the price escapes my range, I have a decision to make. One thing I can do is move my range. I can close out that position and open a new position with a different range and get back to earning. But the main point is that if the price escapes your range, you're going to stop earning. That's the nature of a concentrated liquidity position. We can earn some fantastic yields if the price stays in, but if it escapes, we stop earning fees. Okay, it doesn't mean the price can't bounce, and we selected our range intentionally with where we thought the price would shove back down or bounce back up. So an escape might only be temporary, but you will stop earning fees if and when the price escapes your range. The other thing to understand here is if the price goes down, the value of your position is going down with it. And that just makes sense, right? If you bought SWI for $1.18 and then the price dropped down to $1.05, you're red on that trade. You're losing money on that trade. Now, if it comes back, the value comes back. If it stays down and keeps going down, well, okay, it's going to keep going down. Okay, so it's not like this is completely risk-free. And by the way, I have a whole video about how to set up a delta neutral liquidity position. This is a situation where you have a hedge that is specifically sized to offset your liquidity position. So in other words, if the price drops, you're going to lose value on your liquidity position, but you're going to gain value on the hedge. And they offset each other perfectly. And so that way, if the price crashes, you're not making any money, you're not losing any money net, but the fees, you still get those. So that fee income is pure profit at that point if you set up a delta neutral position. It's a very important topic, especially these days. The crypto markets have been pretty bearish for the last 7 or 8 months. So anyway, this is how you set up the position. You pull the trigger on the zap button there, and I don't know why it's not, there it is. Okay, so I go add liquidity, and it's going to pop up my Slush wallet, and I could just approve the transaction. I'm not going to. I don't know why this is taking forever. There you go. So approve. The $100 USDC is going to leave my wallet, and I'm going to get that deep book, or excuse me, I'm going to get the NFT to represent my liquidity position. Let me reject that because I don't really want to do that. And I'm going to end the video just by showing you my results for this position that I've had open for the last several days. So if we go back to pools and click on my positions, you can see this liquidity position here. This is my sweet USDC position. My range is a little bit tighter than what we discussed, from $1.08 up to $1.40. This is a little bit more narrow. And I actually have, let me just delete some of these extra drawings that I did. And turn on my ranges. So there's my range. I guess it hasn't been several days. Started this on Sunday. Okay. And what you can see, I just collected fees a few hours ago, earlier today, but I have a little bit less than $10,000 in this liquidity position. It's estimating my APR at 155%, not too shabby. Now, of course, this is not guaranteed. The volume can ebb and flow. The price might escape my range, in which case I stop earning fees altogether. But this is just an estimate based on what's been happening so far. You can see at the moment I have $13 available to claim, and it's estimating my daily yield at $42.30. So that's just a little bit more than 0.4% per day. And we saw the math on that a moment ago, round about 12% per month. Now, I started this position on Sunday. I do like to use a spreadsheet to track these liquidity positions. Nowadays, we also have the Overseas DeFi app. So quick plug for the Overseas DeFi app. We are very close to launching our fee tracker application here as part of this app. And you can see this tracks all of your positions, my open liquidity positions, all of my closed liquidity positions. This only works for Base, Ethereum, Arbitrum, and the BNB chain. We will be connecting the SWI blockchain fairly soon. But as for right now, it's just those 4 blockchains. And you can see the fees that I've earned since August of 2024 on this wallet here. So the fee tracker is going to automate all of that, where you can see, the fees that you're collecting, whether you leverage, deleverage the position, withdraw, deposit, borrow. This is a revert position. It's a kind of out of the scope of this video. But anyway, this is a nice, sophisticated way to measure your APRs. Without this, you're pretty much limited to a spreadsheet. And you can see the position. I started it out with $5,300. The next day, I put another $5,000 in there and collected my fees. And you can see here the last 3 days I've been collecting my fees. Kind of averages out to about $40. Let's see. So That was 0.6% per day. That was 0.3, and this was exactly 0.4% per day. This was a big one because there was a ton of volume in the market on that day. That was when SWI was going kind of crazy on Sunday night. But yeah, my batting average for this position, well over 100% yield per year. Okay. So it's a no-brainer. I can borrow capital for 3 to 5%, somewhere in that area. And then I can deploy that very same capital. Here's my Aave screen. You can see I'm currently paying 4.2% on USDC that I've borrowed. I've also set up a short position, a hedge with ETH, and that's only 1.86% interest that I'm paying on these loans. Okay, so I can borrow at a very low interest rate and then deploy into a liquidity position to earn a very high yield. And that's it. I hope that was helpful. No questions in the chat, so maybe next time we'll get one or two questions. I always love the questions in the chat. But, thank you for watching, and I hope it helps. And we'll be back again next week. We're trying to do this every Thursday night at 6 p.m. Eastern. So make sure to subscribe to the channel and turn on those notifications. You'll be notified anytime we go live. And yeah, hope it helps, guys. And I'll see you on the next one. Thanks. Bye-bye.